Hey everyone, welcome back to Corporate Decoder. Today we're diving into Blue Owl Technology Finance's latest annual report. Get ready for some financial deep dives because this one's a real owl pellet, lots of interesting stuff to unpack, a little messy, but hey, that's where the good stuff is. This report gives us a peek into how they performed, what their plans are, and the risks they see on the horizon for 2024, so let's get into it. First, let's establish what Blue Owl Technology Finance actually does. They basically lend money to tech companies. Specifically, they like to focus on software companies, mostly in the United States. They make money off the interest on these loans and also by investing directly in these companies. Their goal is to get the best possible return on their investments. Now let's take a look at some numbers. As of the end of 2024, Blue Owl had investments in 148 companies, totaling $6.4 billion in fair value. Most of their investments were in two industries, software and healthcare technology. In fact, these represented 23.2% and 16.0% of their portfolio, respectively. As a general, they invest 1 to 2% of their portfolio in each company. However, from time to time, certain of their investments may comprise greater than 5% of their portfolio. So, who's in charge of making all these investment decisions? That would be Blue Owl Technology Credit Advisors LLC, who's registered with the SEC as an investment advisor. It's part of a bigger company, Blue Owl Capital. Think of them as the behind-the-scenes experts picking the winners and losers. Blue Owl's credit platform is led by its three co-founders, Douglas I. Ostrover, Mark S. Lipschultz, and Craig W. Packer. These guys have got a lot of experience, and they have direct lending strategies that focus on middle-market companies. The report also touches on some trends in the market. For example, according to Gartner, global technology spend was $5.3 trillion in 2024. Blue Owl is expecting a strong growth in this arena for technology products and services, and thinks technology companies will still require capital to grow their businesses. One of the things they say gives them an edge is their ability to find investment opportunities directly, rather than relying on big banks or other intermediaries. They also offer customized financing solutions that traditional lenders may not provide. The advisor looks for mission-critical solutions, market leadership positions, and strong customer retention in companies they invest in. They seek to limit the downside potential of our investments by negotiating covenants in connection with our investments consistent with preservation of our capital. All this amounts to minimize potential losses and achieve attractive risk-adjusted returns. When the investment team identifies an investment, the Technology Lending Investment Committee will review it. In this report is typically included information on downside protection, asset coverage, and collateral. Once the committee has determined that a prospective portfolio company is suitable for investment, the advisor can then finalize the structure and terms of the investment. They also decide whether or not to employ contractual restrictions to limit companies' actions. The loans in which they invest will have financial maintenance covenants. It's worth noting that Blue Owl Technology Finance Corp does not have any securities listed on a national securities exchange. This means the shares aren't publicly traded, which can make it difficult for investors to buy or sell. If the company hasn't managed to list their common stock on an exchange by August 10, 2025, they'll use commercially reasonable efforts to wind down and/or liquidate and dissolve the company in an orderly manner. The advisor isn't doing this all for free. They get paid a management fee and an incentive fee. The management fee is payable quarterly in arrears at an annual rate of 0.90% to 1.5% of the average of any gross assets at the end of the two most recently completed calendar quarters, plus the average of any remaining unfunded capital commitments to us at the end of the two most recently completed calendar quarters. The incentive fee is pretty complex and depends on what we earn, but a portion is based on income and a portion based on capital gains. They're really aiming to make community our culture. They do this with a global employee volunteerism and giving program, strategic nonprofit partnerships, and other actions to support the communities in which they operate. As a BDC or business development company, Blue Owl is subject to regulations that affect how they can raise capital and borrow money. For instance, they can't typically issue shares below net asset value. As a result, the necessity of raising additional capital may expose us to risks, including risks associated with leverage. Here we see the mix of assets the company has. They had about $4.5 billion in first lien senior secured debt investments and another almost $300 million in second lien senior secured debt investments. We also see hundreds of millions of dollars in unsecured debt, preferred equity, and common equity. There's a big development on the horizon. They're planning to merge with Blue Owl Technology Finance Corp. II. That's right, they are merging with themselves. More accurately, they are merging with a nearly identical company with the intent to combine their holdings and hopefully create efficiencies for the shareholders. But of course, there are risks associated with this merger, including potential difficulties in combining the two businesses and possible disruptions to their operations. And since Blue Owl manages a lot of different funds, there's always a potential conflict of interest. The advisor may have incentives to favor some clients over others, which could be harmful. Since Blue Owl invests in high-growth tech companies, the inherent volatility of the tech sector means that investors could lose all or part of their investment. They are exposed to risks associated with changes in interest rates, cybersecurity threats, and, of course, general market conditions. The company has a lot of measures in place to deal with cyber attacks and prevent being affected, like data encryption and multi-factor authentication. Finally, to address the risks of the company, the aggregate market value of common stock held by non-affiliates as of June 30, 2024 has not been provided because there is no established market for the registrant's shares of common stock. So, is Blue Owl a good investment? Well, that's always a matter of opinion, not financial advice. Here's my take. On one hand, they have a lot of expertise in the tech industry and a proven ability to source deals. Their focus on software companies with their recurring revenue models seems like a pretty solid strategy. They are putting more focus into ESG, which is now what investors expect from a company like Blue Owl. On the other hand, the lack of a public market for their shares makes it tough to get your money out. They're also heavily reliant on a small number of people to make investment decisions, and the upcoming merger adds another layer of uncertainty. Personally, I wouldn't recommend it to every type of investor. You really need to understand the ins and outs of these type of investments before diving in headfirst, and you would need to be comfortable with the risks associated with limited liquidity. Thanks for tuning into this episode of Corporate Decoder. If you found this breakdown helpful, be sure to hit that like button, drop a comment with your thoughts, and subscribe for more financial deep dives.